Last week, my youngest son looked at my wife and I over the dinner table and said he didn't like statistics because all they did was lie. I'm not sure what prompted the statement, but it got me thinking. The thing is, statistics don't lie. Numbers don't lie. They're just numbers. It's the interpretation of those numbers that are prone to lies and misinformations. I say this because some major real estate companies, as well as the mainstream media, like to take data and twist it so that it shows both the worst, sometimes the best case scenarios, when very often the truth is somewhere in the middle. At the beginning of last week, Redfin, one of those large real estate companies, released a report saying that homeowners have lost $2.3 trillion since last June, the height of the pandemic market. Technically, this is true. If you look at the median sales price in June versus the median sales price last January, it does appear as though sellers have totally just taken a bath. Of course, you really only lost that money if you happen to have closed on a home last June and then you sold it again in January. Otherwise, it's a lot like the stock market. You don't really gain or lose money until it's time to sell. The fact is, we shouldn't be comparing the current market to the height of the pandemic era. It's not the same market, and as I've said before, that's a good thing. Last spring, buyers were literally offering to name their first or next baby after sellers. Is this really where we want to go back to? Already housing is as unaffordable as it's ever been. Why do we want to go back to a time where a quarter of the homes sold went to institutional investors to pad their portfolios to make rich people richer? But I digress. The point that I'm trying to make is that it's important to be skeptical of anyone who looks at raw data and says, this is how things are. That would even include me. But with that, let's take a quick look at what Altos Research talked about this week. There are some very interesting tidbits there. Right now, the data points to continued tight inventory all year. At this point, there is no supply side catalyst, think Great Recession redux, that would lead us to believe that there is going to be an influx of homes on the market in the immediate future. In fact, according to Altos, we can expect inventory to continue to decline by maybe another 1.5% over the next few weeks as we head into the spring market. As I said a couple of weeks ago, this year is continuing along the same pandemic track of the spring market starting later, like in May. At the same time, higher interest rates appear to keep home prices down, or at least on par with where they have been recently. According to Altos, again, this week home prices are holding steady week to week. Historically, home prices are starting to increase by now. The price for new listings last week was unchanged year over year. This indicates that sales prices will be about the same or less than last year over the next few months. But it's important to put this data in perspective because we can't really compare 2023 to the last 3 years. They are completely different markets. Inventory, as well as interest rates, are significantly higher now. The market is tracking closer to 2018, 2019, and so it's instructive to take a look at where the market was then and compare that to now. In the second quarter 2019, our last normal sales year, the median home sales price in American Canyon's Rancho Del Mar subdivision was $420,000. Today, I just put a listing on the market over on Carmel that came on at $528,888. That's a 26% increase over the last 4 years. For that same period, the median sales price for all of American Canyon was $544,000. The highest sales price in the second quarter in 2019 was 15 Hallmark Court, a 5-bed, 3-bath, 3,600 square foot home that sold for $730,000. Today, the median list price for American Canyon is just a little over $797,000. Happily, there have been a couple of interesting developments in the government world for housing. Fannie Mae announced important procedural changes in its March selling guide. Fannie Mae, the organization, said they'll now accept a range of options to establish a property's market value, which means they're moving away from implying that appraisal is a default requirement. At the same time, the House of Representatives just passed legislation making it easier to have remote online notarization. The Senate will have to take up the legislation, but it's a step toward progress in the 21st century, which is phenomenal. Speaking of mortgages, it honestly feels like the bond market just wants to go down. It panics on some news like minor inflation uptick or the Fed's talking, and ignores other data like ISM, manufacturing, Fed surveys, yield conversion, curve inversion that would normally be really favorable. So I'm not entirely sure what to make of it, but reading between the lines, I don't think that the market will be comfortable until it actually sees inflation dropping and job losses rising, which means that we probably won't see interest rates in the 5% until that happens. As it stands now, the average 30-year mortgage rate is at 6.94%. Nearly all of those hard-fought gains between November 2022 and January 2023, which helped drive inflections in builder and buyer confidence, pending home sales and new home sales, they've all been erased. The next Fed meeting will be held on March 15th and 16th, and they are expecting another 25 basis point increase, which isn't so bad. It's down from 75 where we were. Now, I may have mentioned inventory before, and the good folks over at one of the blogs I like to regularly read had a good to-do on new construction. But let's start off with the big questions. If we've got a housing shortage and that's driving home prices higher, then why don't the big builders just crank out more homes? It really is a great question, especially here in the US, where the supply usually reacts to increased demand very quickly. Unfortunately, it's not a simple answer, and of course it never is. But here are a few problems that developers are up against to increase the demand or supply. One is onerous regulations, such as the availability of land, speed of permits, the cost of permits, NIMBY protests via CEQA lawsuits, and labor shortages, like skilled workers, are not new issues for the construction industry, but they've both gotten worse over time. While more recently, material supply issues, like long lead times for many products, think a refrigerator, and much higher material prices are a legacy of COVID-driven bottlenecks. In fact, however, builders have already responded to pandemic-era demand with building permits and homes under construction at levels not seen in 15 to 20 years. It's just not enough, and here's why. Over the last 5 years, the number of new home sales have ranged from 600 to 800,000 annually. Generally, in the US, we need to build about 1.5 million homes per year to keep up with demand. The home construction industry is highly cyclical, with annual residential completions ranging from nearly 2 million units in 2006 to 584,000 in 2011 and back to 1.4 million in 2022. Many of the largest builders are listed on the stock exchange, adding additional pressure to maximize earnings rather than the number of units built or sold. But here's some good news. 1.67 million housing units were under construction at the end of 2022. That's a record level. It's up 44% from 1.16 million in 2019, pre-COVID. Over the next 7 to 10 years in American Canyon, there will be 1,200 new homes for sale in Watson Ranch development. There is significant additional new construction all over the region in Cordelia, Green Valley, Fairfield proper, and Vacaville. Hopefully, this will ease the housing burden and lack of affordability in the region over the coming years. So this week, I'd like to end on a good note. Ryan Schneider, CEO of Anywhere Real Estate, former Realogy, said earlier this week that, quote, the outlook for housing over the decade is strong and most importantly, potentially exciting right now, as we may be at or near a bottom already. We have all seen a number of the housing indicators in the macroeconomy exhibit more stability. And that's all for this week's Peterson Report. Enjoy the weekend.